Welcome back to the Micro Learning Institute. In this short tutorial we're going to look at a past exam question in the area of IAS 16 Property, Plant and Equipment. This question is from the ACCA F7 paper from June 2009 and the question is titled Flightline. This question relates to a complex non-current asset. This is an aeroplane and we're asked to deal separately with the exterior structure of the plane, the interior cabin fittings and the engines. The requirement of the question is to calculate the charges to the income statement for year ended the 31st of March 2009 and also the carrying amounts on the statement of financial position at that date. Let's begin by looking at the exterior structure of the plane. In the question you can see we are told that the exterior structure was purchased on the 1st of April 1995 for $120 million and that it has an estimated life of 20 years. Consequently, we capture the cost at the 1st of April 1995 at $120 million. We calculate the depreciation for the 13-year period to the opening balance sheet at $78 million, giving us an opening balance on the 31st of March 2008 in relation to the exterior structure of $42 million. The depreciation charge for year ended the 31st of March 2009 is calculated at $6 million. This depreciation is recognised as an expense to the P&L, leaving a carrying amount on the 31st of March 2009 of $36 million on the statement of financial position of this company. Next, let's look at the interior cabin fittings. Firstly, we are told that the interior cabin fittings were replaced on the 1st of April 2005 for $25 million and that they have a useful economic life of 5 years. Additionally, in the body of the question we are told that Flightline took the opportunity to upgrade its cabin facilities at a cost of $4.5 million. Even though this upgrade did not increase the estimated remaining life of the fittings, the improved facilities enabled Flightline to substantially increase the airfares, so consequently we can capitalise this investment. So firstly, we consider the cost on the 1st of April 2005 at $25 million. We recognise 3 years of depreciation to the opening balance sheet on the 31st of March 2008. This totals $15 million of depreciation, leaving us with a balance brought forward in relation to interior fittings on the 31st of March 2008 of $10 million. As the upgrade did not happen until the 1st of October 2008, we need to charge 6 months of depreciation. This $2.5 million depreciation expense goes to the P&L, leaving us with a carrying amount on the 1st of October 2008 of $7.5 million in relation to interior fittings. The upgrade to the interior fittings on the 1st of October 2008 is capitalised at cost of $4.5 million. Consequently, the total carrying amount equals the $7.5 million plus the $4.5 million, which equals $12 million. We now charge depreciation on the $12 million for the remaining 6 months of the year. Bear in mind that the useful economic life of the interior fittings remains for an existing 18 months. This depreciation charge is also charged to profit and loss, leaving us with a balance carried forward in relation to interior fittings of $8 million on the statement of financial position of Flightline. Next, we need to consider the engines. Now in the question there are 3 engines, 1 an engine that was lost, 2 an engine that was repaired, and 3 a new engine. Firstly, let's consider the engine that was lost. We are told in relation to the engines that there were 2 engines which cost $9 million each, and they were replaced on the 1st of April 2005 at a cost of $18 million in total, and their estimated life was 36,000 flying hours. Following a bird strike on the 1st of October 2008, 1 engine was damaged beyond repair. In relation to this lost engine, we see the cost on the 1st of April 2005 was $9 million. The depreciation on this lost engine can be calculated based on the $9 million cost in relation to the 36,000 hours estimated as the useful flying time of the plane versus the 10,800 hours that had actually elapsed since the engine was purchased. Hence, the carrying amount brought forward on the 31st of March 2008 in relation to this engine was $6.3 million. As the engine wasn't damaged beyond repair until the 1st of October 2008, we calculate further depreciation in relation to the 1,200 hours used by this engine up to the 1st of October 2008. This depreciation of $300,000 is charged to P&L for the year. Hence, on the 1st of October 2008, this engine had a carrying amount of $6 million. As the engine was damaged beyond repair, we recognise a full write-down of the full amount of $6 million to the profit and loss and zero balance in relation to this engine on the balance sheet at year end. Next, let's consider the repaired engine. We are told that this other engine was also damaged, but it was repaired at a cost of $3 million. However, its remaining estimated life was shortened to 15,000 hours. Again, for this repaired engine, the cost on the 1st of April 2005 is $9 million. And as per the previous engine, we recognise depreciation to give us a balance brought forward on the 31st of March 2008 of $6.3 million in relation to this engine. Again, as the accident did not occur until the 1st of October, we recognise further depreciation of $300,000 to the P&L, giving us a carrying amount on the 1st of October 2008 of $6 million for this machine. At this point, we are told that the company spent $3 million repairing this engine. However, this $3 million expenditure did not result in any increase in economic activity in relation to the engine. Consequently, the $3 million cannot be capitalised and must be recognised immediately as an expense to P&L. This repaired engine is depreciated over its remaining reduced useful economic life of 15,000 hours for the 1,000 hours that elapsed to year end, giving us a depreciation charge of $400,000. This depreciation charge of $400,000 is charged to the profit and loss, giving us a balance carried forward in relation to the repaired engine at the 31st of March 2009 of $5.6 million. This $5.6 million goes to the balance sheet at year end. Finally, we are told about a new engine at a cost of $10.8 million with a useful economic life of 36,000 hours. Firstly, we look at the cost of this new engine on the 1st of October 2008 at $10.8 million. We consider the depreciation for the 1,000 hours of flying time with respect to the useful economic life of 36,000 hours of $300,000 of an expense. This $300,000 is charged to P&L, leaving us with a balance of $10.5 million on the balance sheet at the 31st of March 2009. So in summary, on the P&L for all of these transactions, we have the external structure depreciation of $6 million. We have interior depreciation totaling $6.5 million. We have the depreciation on the engine that was lost totaling $300,000. We have the lost engine write-down of $6 million. We have the depreciation on the repaired engine, which totals $300,000 plus $400,000, that's $700,000. We have the repaired engine repaired cost of $3 million. We have the new engine depreciation, and finally we have the painting expense, which had to be expensed in the period, giving us a total P&L expense in relation to all of these transactions of $24.8 million. Similarly, we can look at a summary statement of financial position at the 31st of March 2009, where we have the external structure at a carrying amount of $36 million, the interior at a carrying amount of $8 million, the lost engine completely written down to zero value, the repaired engine at $5.6 million, and the new engine at $10.5 million, giving us a total asset base in relation to these assets of $60.1 million. Thank you for watching the Micro Learning Institute.